Okay, we'll be looking at a demonstration of our understanding of how to prepare a reconciliation statement when you are switching to IFRS compliance in a particular financial period. So we'll be looking at a grip test 2 to demonstrate your knowledge of your ability to be able to prepare a reconciliation statement. Don't forget, this reconciliation statement is a requirement of International Financial Reporting Standard 1 for first-time adopters. That standard says as part of your disclosure requirement, you should be able to prepare a reconciliation statement of your statement of financial position as at the first day that you are preparing your financial statement to be IFRS compliant. You must be able to prepare a reconciliation statement of your income statement as at the first day that you are preparing your IFRS compliance report. So let's use this test to demonstrate our practical understanding. Now, this is a full set of an extract of a financial statement. If you look at this, we have other information from A to E. And when you see question like this, the first thing you go to is a question requirement before you even read through the full set of the financial, the full set of the requirements in the exam hall. You must make sure that you familiarize yourself with what the examiner is asking about. Now, the first set of the requirement, it says you should explain your understanding of your gap analysis. Gap analysis, now number one, if you want to provide your solution without looking at your comprehensive set of accounts, you will see that this one does not require reference to the to questions before you answer it. So this does not require reference to your question before you answer it. Is a theoretical based question that you can answer. Now let's just answer this one straight away without looking at the question. Now, what do we mean by gap analysis? Gap analysis is just a way of remodifying a requirement of IFRS about what we call the reconciliation statement. So it's a way of giving it a name. For example, in our learning of management, we're able to describe a gap analysis as a difference, as something that is a difference between two things. It is actually something that is what we call a variation. So that is a literal definition. It is what? A variation in two. When we relate that to financial report, so gap analysis is what? A variation in comparison of two sets of financial reports. Comparison of two sets of financial reports. So it is the what? The variation that comes from the comparison of two sets of financial reports. This gap analysis is from the requirement. Of IFRS 1 for first-time adopters. It's from the requirement of IFRS 1 for first-time adopters of IFRS for financial statements. So this reconciliation report, in a nutshell, we call it what? Gap analysis. So by the time you are looking at a difference, so the gap analysis explain, by the time you are looking at explanation of a difference between financial statements, financial statement prepared in line with previous local regulation, For instance, in Nigeria we call it SAS, and those prepared in line with IFRS on the first date of reporting. So that is what we call gap analysis. So gap analysis look at the adjustments. By the time you look at gap FS, you have adjustments, then you have IFRS FS. So that adjustment, it means the adjustment between this and this is what you call your gap analysis. So it is a very, very simple definition. You can define gap analysis by way of a variation between two sets of financial reports. These two sets of financial reports, now we are talking about the financial statement prepared in line with previous generally accepted accounting practices. In Nigeria, that's the statement of accounting standard, and you're also looking at the one prepared in line with international financial reporting standard on the first date that you are switching to that application. So that is about an explanation of gap. The second question requires us to prepare a reconciliation statement. It says prepare a reconciliation statement extract for Super PLC statement of financial position as at 1st December 2011 and 31st December 2012. So look at this. It means this, like we have learned from our previous study, this is a requirement of IFRS 1 for disclosures for first-time adopters. Now, when you see this kind of a requirement, the first thing you should do in your answer sheet is to go to the page where you are actually answering those requirements. So what does that requirement say? Requirement number 2. It says reconciliation. Just write it out. Reconciliation statement of equity as hat. Now you are going to be a little bit careful here, because if you look at the requirement of the question, it's actually asking you to prepare that reconciliation report for 2 years. If you look at this, now you have to now go to the question requirement to be able to understand what that question is talking about, because that is purely a requirement that for you to be able to answer, you need to understand the trend of that question. Now let us go to the question together. Furtherance to Super PLC's case 1 above with the following additional information. Now, from our definition of application of the first group test, which is identifying the period in which the reporting entity is able to adopt IFRS, we were able to establish that the first IFRS statement that this guy is going to present is 2012. However, he has to present a comparative figure in 2011. Now I'm going to go forward to the question here. So we know that we are presenting this question based on a transition period of 2011. Then we have a reporting period of 2012. We have a reporting period for 2012. Now, financial statement extract under SAS. This financial statement has been prepared in line with local GAAP. This is what you have. You have for 2011 and you have for 2012. you have for 2012, and you have for 2011. Now if you look at this, we have asset category, property, plant and equipment, intangible assets. You have total non-current assets. Then you have inventory, trade, and others. So we have current liability, non-current liability, total equity. We have equity portion, we have share capital, share premium, retained earnings, total equity. Now, other information section, you were told that the company decided to carry property, plant and equipment at a revalued amount of 13.9 million. I think this should be million. 13.9 million as at 1st December 2011. The component of each item of property, plant and equipment was carried out, and each component was depreciated separately using a straight line method based on the estimated economic useful life and residual value. The estimated useful life and residual value at the end of each reporting period are expected to be reviewed. The impact of the component revaluation was an increase in depreciation expense by 73 million naira for the period ended 31st December 2012. Depreciation on other PPE for the year ended 31st December 2012 is 358 million. Now, we also have the B part. The company normally classify computer software under previous GAAP as part of property, plant and equipment. The amount of this component is 1.8 million for the period ended 31st December 2012. An examination of the software purchase agreement review, it can still be used for a period of 10 years. Now if you look at what we have here, the computer software under previous GAAP, the issue is that he has classified this as part of PPE, and this should have been what? Intangible assets. This should have been what? Intangible assets. For every question, additional information in the question, you need to be able to identify what to be done. It means you need to what? Reclassify computer software. You need to deduct it from property, plant and equipment. The figure is 1.8 million. That means you deduct it from property, plant and equipment of the previous GAAP, then you add it to intangible assets. Now if you also look at this, it says an examination of the software purchase agreement review, it can still be used for a period of 10 years. It means from the very first day that you are recognizing it as an intangible asset, you need to be able to amortize it. Amortization over useful life. Over useful life of 10 years. Now, for your amortization policy, everything that you are applying under intangible assets, which aspect of the standard talks about that? That is IAS 38. So you need to be able to understand the position of IAS 38 as it relates to treatment of an intangible asset, for you to be able to address that question requirement. Now for the C part, it says the company has a spare parts component which has been recorded as part of inventory at value of 52 million naira as at 31st December 2012. Remaining useful life of the spares is envisaged to be 10 years. Now if you look at this, the spare parts component has been recorded as part of inventory, and if you look at the useful life of that spare part, it's showing 10 years. Now there is a position of two positions you need to talk about here. The first position is IAS 16, which is on what? Property, plant and equipment. The second position is on IAS 2, which is your inventory. So what the standard talks about in recognition of spare parts in your component is it should be recognized as an inventory, provided it does not the use of that asset does not exceed 1 year. Exceed 1 year. So what it means is it is used for a what? it has a what? A shorter lifespan. It has a shorter lifespan. Now, when a spare part is expected to have a longer lifespan, spare parts with longer lifespan, and not only longer lifespan, it also lead to functionality. It also leads to functionality of the main asset, or of the main asset, without which it cannot function alone. It cannot work alone. Then it has to be capitalized along with the cost of that main asset. Now, if you look at this spare part in this question scenario is expected to be used for 10 years. It means it is a wrong classification to have included it as part of your inventory figure in that financial period. So we are as at the date you are switching over to IFRS, you have to reclassify this particular spare part from inventory to property, plant and equipment, and also calculate a depreciation. You need to decide on your depreciation policy based on the useful life on that spare part. Now, on part D, both current liabilities and non-current liability positions remain the same for the reconciliation period. So it means no adjustment affect your current liability and your non-current liability. Then we also look at the E. It says at 31st December 2011, expenses relating to issue of shares has been included in share capital and share premium at 99,000 and 41,000 respectively. The accountant has charged these expenses in the period. We also recognize the corresponding increase in equity. So what the accountant has done here, is that he has debited his expenses for maybe 99,000 or 41,000 as the case may be. Then instead of him, because he paid those expenses and guys, instead of him to credit bank or cash, he recognized this in equity for the same amount. So let's look at the implication that one is having on what he's supposed to have done. He's supposed to have. So what he's supposed to have done is to debit expense, or this kind of expense is what we call share issue expenses. So the position of the standard for share issue expenses is that it should be expensed. Now it should have credited bank or cash. Now, so let's look at the implication that one has on his financial report. You will see that that explains what he has here, and he explains what we have here. So we need to take it out from here and include it as part of our bank or cash. Now let's quickly go to our calculations. Now we want to prepare a reconciliation statement. The first thing you are going to do in this kind of question is to set your format